Silver was trading above $100 an ounce earlier this year. It's at $70 now. That's not a small correction. That's 30% gone. While the supply deficit is still running, while industrial demand is still growing, while the biggest banks on Wall Street are still publishing price targets well above where the metal is trading today. So the question isn't whether silver is going up or down next week. The question is, why is a structurally undersupplied market trading this far below what the fundamentals suggest it's worth? And does that gap eventually close, or does it just sit there? That's what this video is about. And it starts with a number that most people glance past without actually sitting with it. The Silver Institute's latest outlook puts the 2026 global silver deficit at 67 million ounces. That's the sixth consecutive year where demand exceeds what the world mines. 6 years in a row. Let's talk about what that actually means. Mine supply is projected to grow about 1% in 2026, reaching roughly 820 million ounces globally. 1%. That's not a rounding error. That's the ceiling on how fast this industry can respond to higher prices. And it's not arbitrary. Silver mining has structural constraints that price signals alone can't fix. Permitting a new mine takes years. Building it takes more. And a large share of the world's silver isn't even mined for silver. It comes out of the ground as a byproduct of copper, zinc, and lead operations. Which means silver supply moves with base metal economics, not silver economics. When copper producers make capital allocation decisions, they're not thinking about silver spot prices. The gap between supply and demand is filled partly by recycling and partly by drawing down above-ground stocks. Both of those levers exist and are being used, but they're not infinite and they don't grow on their own. Recycling follows price. When silver is expensive, more comes back into the system. When it's cheap, less does. It's a partial buffer, not a solution. Now, a reasonable person at this point might ask, if the deficit has been running for 5 straight years, why didn't prices blow up years ago? That's a fair question. The honest answer is that markets can absorb deficits for longer than you'd expect when above-ground inventory is large enough to cover the shortfall. The 2020 started with significant above-ground stocks built up from prior years of surplus. Those buffers are being drawn down. The longer the deficit runs, the thinner the cushion gets. And at some point, the math becomes unavoidable. One more data point worth holding. The gold-to-silver ratio is currently around 63 to 65 to 1. Gold has historically traded at around 70 to 90 times the price of silver. That ratio compressing, silver outperforming gold, is actually part of what happened when silver ran above $100 earlier this year. The ratio is still below its long-run average, which is either a sign the silver rally was real and justified, or a sign there's room for silver to keep pace even if gold pulls back. Most analysts read it as the former. The supply picture is one half of the story. The demand side is where things get more interesting, and where the argument gets more honest. Silver's industrial demand is driven by 4 things right now: solar panels, electric vehicles, consumer electronics, and increasingly, AI infrastructure and data centers. These aren't trends in the casual, journalistic sense. They are long-duration capital commitments by governments and corporations that don't reverse on a quarterly earnings call. An EV uses roughly 2 to 3 times more silver than a traditional combustion engine vehicle for wiring, contactors, and battery management systems. Solar photovoltaic cells use silver paste in their electrical contacts because silver is the best electrical conductor we have at commercial scale, and nothing else has replaced it. Data centers run hot and need reliable conductivity throughout. AI accelerates the build-out of data centers. The silver demand from these sectors is compounding. Here's where I want to push back on something though, because if you came into this thinking solar going mainstream is straightforwardly, unambiguously bullish for silver, the picture is slightly more complicated than that. Manufacturers are thrifting. That's the industry term for engineering processes to use less silver per unit, reducing the amount of silver paste per solar cell, for example. When silver ran to $100, manufacturers had a strong financial incentive to figure out how to use less of it. They've made real progress. Silver intensity per panel is lower than it was 3 years ago. So does that undercut the demand case? Not really. Here's why. Thrifting reduces silver per unit. It doesn't reduce total silver demand if the number of units is growing faster than the efficiency gains. And right now, solar and EV deployment are growing at rates that, under Bloomberg, NEF, and Silver Institute projections, still produce rising aggregate silver consumption even after thrifting is accounted for. By 2027, EVs are projected to overtake traditional vehicles as the primary auto sector silver consumer. That's a structural shift, not a seasonal one. The demand case isn't bulletproof. It's contingent on deployment rates staying strong. But it doesn't require optimism. It requires current trends to continue at roughly current pace. If the fundamentals are this solid, what's holding the price at $70? The honest answer is real yields and the dollar. And understanding why those two variables matter is the key to understanding where silver actually is in this cycle. Real yields, the yield on 10-year TIPS, which strips out inflation, are running at about 2.08 to 2.10% right now. That's elevated. And it matters for silver specifically because silver pays nothing. It doesn't yield income. When the alternative to holding silver is a government bond paying a 2% real return, capital has a reason to sit in the bond instead. That's not sentiment. That's basic arithmetic about opportunity cost. The US dollar index is trading near 99 to 100. Silver is priced in dollars globally. A stronger dollar makes silver more expensive in every other currency, which reduces demand at the margin from international buyers. It also signals that the US economy is holding up, which reduces the urgency for safe haven positioning. Inflation is running around 2.7 to 2.8%. You might expect that to help silver, and in theory, inflation should push investors toward real assets. But the variable that actually drives precious metal positioning isn't nominal inflation, it's real yields. If inflation is 2.8%, but rates are high enough that real yields stay positive and meaningful, the math still tilts away from non-yielding assets. Silver is caught in that dynamic right now. What changes it? A few things. Softer US growth data that gives the Fed cover to cut rates. A Fed that begins easing, which would compress real yields. A dollar that weakens as rate differentials narrow. None of those are happening this week, but none of them are structurally impossible in the next 12 months either. Here's a question worth sitting with. Do you think the Fed is cutting rates before the end of 2026? Because that single variable, more than the deficit, more than EV demand projections, more than any analyst target, is the most important short-term driver of where silver trades next. Think about it. Whatever your answer is, it should inform how you're positioned. Now let's look at what the professional money is actually doing. JP Morgan's 2026 silver average forecast is $81 per ounce. Goldman Sachs has published notes in the $85 to $100 range for parts of the year. Bank of America sits around $75. The consensus across more than 30 analysts points meaningfully higher than current levels. That doesn't mean they're right. Bank targets often lag turning points, and they sometimes track price more than they lead it. But consistency across independent institutions with access to the same data is a signal worth noting. SLV, the main silver ETF, saw daily inflows exceeding $600 million on some days this week. Holdings remain elevated. Hedge fund 13F filings from late 2025 showed increased SLV exposure from major institutional trading firms. That means professional capital is buying at these levels, not exiting. Warren Buffett has never been a precious metals investor, and nothing about that posture has changed. That's worth saying because the silver bull case can sometimes shade into a worldview where every serious investor is on board, and that's not accurate. Smart people disagree. Buffett's framework, productive assets, durable earnings power, simply doesn't include metals as a category, and that's a coherent position. But here's the point. The majority of institutional money right now is not treating $70 silver as a fair price. They're treating it as an undervalued price relative to their models, and they are allocating capital accordingly. Retail investors watching from the sidelines aren't competing with unsophisticated buyers. They're looking at the same market where professional money is moving in. So where does this go from here? There are 3 scenarios worth mapping clearly, because thinking in scenarios is more useful than guessing at a number. The base case is the center of gravity. The structural deficit continues at roughly current levels. Industrial demand grows in line with current EV and solar deployment trends. Macro headwinds, elevated real yields, firm dollar, gradually ease as the economic cycle progresses. Silver trades in a $60 to $90 range over the next 3 to 5 years, with periodic volatility around data releases and Fed communications. This scenario requires no major surprises. It just requires the current trajectory to continue. The bull case requires the macro ceiling to lift. Real yields fall as the Fed moves toward easing. The dollar weakens as rate differentials narrow. EV and solar adoption comes in ahead of current projections, perhaps driven by policy acceleration in Europe or China. The gold/silver ratio compresses further toward its historical average. Any combination of 2 or 3 of those conditions could push silver well above $100 again. This isn't a fantasy, it's a conditional. It has a clear set of triggers. The bear case requires something to actively break in the fundamental story. A sharp global growth slowdown that hits industrial demand directly. A dollar that strengthens substantially further, perhaps driven by a flight to safety in U.S. assets. A genuine breakthrough in thrifting that reduces aggregate silver demand even as unit volumes grow. Any of those could push prices temporarily toward $50 to $60. Temporarily, because the supply side can't respond to lower prices by producing significantly more, which puts a floor under the bear scenario that doesn't exist in, say, a commoditized industrial metal. Which scenario do you think is most likely right now? Not where silver trades next week, over the next 2 to 3 years. The answer to that question is what should determine your positioning, not the price action from any given week. The risk-reward at $70 for an investor with a multi-year horizon looks asymmetric to the upside. But asymmetric doesn't mean certain. And it definitely doesn't mean comfortable to hold through volatility. Silver at $70 isn't a broken trade. It's a patient one. The fundamentals haven't deteriorated. The macro environment is making them temporarily invisible. The investors who tend to do well with this metal are the ones who understand the difference between a story that's over and a story that's waiting for its next chapter. Silver is in the second category. Everything in this video is analytical and educational. It is not financial advice. The analysis here reflects publicly available data and one perspective on how to interpret it. Your situation, your risk tolerance, and your time horizon are yours to weigh. Do your own research and make your own decisions.